Everyone, welcome back to my channel. Today I want to do a recap of the last hour of the day on January 27th, 2023 using TradingView Dealer's Market Diary, which is essentially a very practical way of viewing and using charm. I ended up taking this trade and calling out how I intended to play it on Twitter using ES beforehand. However, I think it would be beneficial to review that tweet, what I was looking for, and how I could have done even better. I was able to catch 19 points on ES with a chunk of my position, but despite that, some mistakes were made and there's always room for improvement. Before we get started, I'll leave several discount codes for trading services I use in the description, including TradeEdX, Voland, and Elite Trader Fund. Lastly, if you enjoyed this content, don't forget to like and subscribe to help me grow this channel. Also, be sure to hit the notification bell to get notified whenever I post a new video. With all that being said, let's just get right into it. So, this is the post that I was referring to that I did on around 2:45-ish on Friday before Dealer's Market Diary took effect. It was a requote of what TradeEdX had posted, showing that calls were at around 3.6 billion that need to be de-hedged, which will lead to selling. Now, if you don't understand that, I've done several videos on Dealer's Market Diary on this channel. It is part of my overall trade plan, so definitely check those out. Now, in this case, I said I'm planning to short this on ES from a character change. Now, I am going to show this on SPY instead because the price action is the same and I want to demonstrate that. But so in this final hour, I'm going to look for a character change, meaning that I was currently in longs, so I was going to go flat around 4,100, then wait for a lower low to form, followed by some sort of fair value gap or order block retest, which would effectively be a lower high, then short with my target at 40.8250. And if the opportunity doesn't present itself, I won't force it. So let's talk about what that means here. So if we look at ES, we can see this was my target. I'm targeting this because I know that there is sell side liquidity here. What I mean by that is that, and you can see this on Bookmap, right? You can see how the market loves to target liquidity, whoever's driving it, whether it be institutional banks or market makers, whatever it might be. Whenever there's areas of obvious resting liquidity, in this case, it would be in the form of sell stops because people were taking longs all day, myself included. And if they got in longs here, or even if they're just sliding their stops along the way, the most obvious place to do it is right around areas where traditional traders consider to be support and resistance. And the reality is, it makes it obvious to know that there's a whole bunch of liquidity here in the form of stops that are resting for institutions to target so they can match orders. And that's the whole principle behind liquidity and what drives things. So seeing these equal lows here made this my target. Now, as I mentioned, I'm going to talk about this on SPY, which is shown here. We have these equal lows, which is going to be my target if things start to shift. Now, this was a very bullish day. I ended up exiting my longs somewhere around 4,100 on ES, which if we go over was right around this point. So if we flip back to SPY, we're moving up, moving up. This is the fair value gap I had also referenced in that tweet. I wanted to see us get through this. So this was my first area that I was noting. The reason being is because of the obvious imbalance here on the 1 minute. This happened at the 215 candle, which I mentioned in that tweet. We move higher. I end up exiting in anticipation of the last hour. I could have held a bit longer, but I just wanted to be flat and wait for my setup. So now let's talk about what that setup looks like and how I could have done this better. So we'll just play through this. We could see that we're getting these wicks right here, which this would be shorting the top and is something I never would do because we could easily get faked out, could just move. We don't know for sure it's going to go down. We can't just trust that because there's calls expiring that need to be de-hedged that we're going to get a big move down. So we need an indication, some sort of confirmation that we can take that. And this is why I always pair price action with anything that I'm using to help get extra insight into the market. It's so incredibly important. But anyway, if we watch this happen, we can see we get a nice move down. This is our first indication that there's been a big splash, that there's now institutional sellers or dealers selling in order to de-hedge, right? That's what creates these big candles. Also, these big candles are what are going to create our entry mechanisms, which are very important. And so this is what I meant by entering off fair value gaps. Now we actually end up getting two fair value gaps here, right? That I ended up marking down. We have this fair value gap and we have this fair value gap. These are areas of imbalance that will act as not only areas that the market wants to rebounce by bringing price through it, but also if we are actually bearish, we can see a rejection off of these. These can act as resistance. Now, as the market moved down, we ended up getting a change of character. right here when these lows are broken out. This was my first sign. Okay, now I need to look for a lower high off of these fair value gaps. Now what I did wrong is because of some impatience. So right here, when we came back and we tested this fair value gap, this is where I went short. And there's a couple of things to note about this. One, I went in with my full position, which I really should have went in with 1/3. And the reason being is because of this fair value gap up here. In reality, the most optimal setup would be able either to come into here and reject, or even to come into this order block and reject, which we have formed right here from this change of character. So, however, I didn't want to miss the trade. I was being a little impatient. What I did wrong was go in my full position. Ideally, I should have just gone in partial and then averaged down more up here as long as the trade was still playing out. And then, of course, have my stop up here if it doesn't go my way. So what happens here as well, which I could have really utilized to my advantage, is this candle right here. And this is a classic liquidity grab. So what happens is, as we blow out this low and we attack that sell side liquidity, they blow out these stops perfectly, trigger these stops, anyone that had tight stops in this area, and then move higher. Honestly, right here, I should have immediately have gotten out and waited to reload once we clear this fair value gap and reject off of this area up here. However, I just stayed in. It caused unnecessary pain, which actually caused me to exit some of my position early. I did actually indeed pull through the bulk of the position that I made a post about. You can see my entries here. The blue line is the remaining positions I have. I'm sliding my stops down. And as I recapped it, by the time I got there, we did end up getting my target as a spoiler alert if you didn't see it on Twitter. But regardless, now we're looking to see, one, if this fair value gap gets cleared, two, if this gets cleared, and three, if those things happen. Typically they will target the highest fair value gap before moving lower. And when I say they, I'm talking about institutions, market makers, the real drivers of the market, the ones seeking liquidity in order to fill the orders they need. Now, as we come up here, this was the optimal entry. Some people on Twitter did post and did take it, which is fantastic. I personally did not, and like I said, it caused unnecessary pain. Again, one thing too is this actually looks like this is going to continue holding, right? Again, just more confirmation, hey, maybe a partial position isn't bad here. And if we move higher, we don't stop out, we can just average down up here. And so as we come higher, we fill that fair value gap, continue moving higher, higher. Now, one thing to note is this fair value gap should actually hold. And I want to show QQQ at this time because QQQ actually gave excellent confirmation. So QQQ came all the way back up to this order block and then rejected. So did NQ, of course. So unfortunately, I had a bit of tunnel vision, and that would have been a fantastic opportunity to add more to this position. But again, I was sort of zoned in on what was happening, wasn't properly checking my correlations here. So we move higher. We do hold this fair value gap. This is optimal entry to buy puts or take shorts, or in my case, I should have averaged down more shorts, which I did not. Despite that though, the move starts and we just get exactly what we expect in these situations, which is a rapid sell-off. So we made change of character, made a lower high, held in a fair value gap order block, which is exactly what I said I was looking for, and then a big drop. The first area of interest we take out is this fair value gap that I noted in my tweet that I want to see get taken out. And of course, it does cause a little bit of support here, right? This could fool people into thinking that, okay, it's time to close up. And I actually did close some partials here, but not everything. Then of course we get the big move through it, and then we just continue to rapidly sell off. Again, we're targeting the liquidity at these equal lows, expecting the market makers to take these out. And sure enough, they take those out and boom, the market closes. So it was a beautiful trade. Again, on ES, I ended up getting in right around 403.25. And we did get the drop to 40.8250. I did take partials out along the way. However, I did still have 3 contracts that I held all the way to the end, which ended up working out perfectly. Could have done some things better, but overall I'm very happy with the trade. And this is picture perfect how I always trade, not only dealer's market diary, but how I trade trend reversals in general. If we look at earlier in the day, we can see the same sort of thing happen twice before, right? We're moving up, moving up. We get our initial New York open, what some would consider a Judas swing or a big liquidity grab, where we're just moving above, moving above. Then we reverse here. We make a lower high, continue down. We could take off the order block entries or the fair value gap fills, right? This is probably the safest entry over here on these candles and wicks. Then once again, as we move lower, we take out this liquidity here, and then we shift. We get a new high right here, make a higher low, and then boom, we run higher with the expectation that we're going to take out these highs. And so that's just basically how I trade it every day. When we see these shifts, we target the obvious areas of resting liquidity, and that's that. And so Dealer's Market Diary helped give that extra insight that there would be an end of day sell-off because of end of week options expiration. And actually, even though it's not monthly OPEX, it is end of month as well, which helps lead to these bigger moves. So because it's beyond options, there's also things happening in futures where short positions, long positions are being closed, which, causes selling, things of that nature. So anyway, I hope you found this recap helpful, and I will actually try to, at some point in the future, if there is a Friday afternoon where I can do one of these Dealer Market Diary entries with you guys, I'm going to try to do it live. Maybe even during like the March quad witching or something of that nature. We have a nice big build up of options expirations, but I hope you find this helpful, and I will see you in the next one.